Welcome, everyone, to a deep dive. We're focusing today on something pretty specific, actually, that we know comes up for many of you in the Luxembourg fund world.
That's right. We had a request to really explore structuring a cross-border acquisition.
Specifically involving French companies, but doing it through a Luxembourg SOPARFI. That's a Société de Participation Financière.
And this kind of structure, well, if you're a lawyer or in finance, a director, maybe compliance, company secretary, you've likely seen this, or you probably will. It really meshes international tax strategy with the nuts and bolts of actually doing deals across borders.
Absolutely. And guiding us today, we have this really detailed report. It's dated today, May 8, 2025.
Yes. Hashtag 0011 Luxembourg SOPARFI acquisition research.
That's the one. It really unpacks everything: strategy, legal, tax, regulatory stuff. Yeah. For a French parent company, let's call them Parent Co.
Okay.
Setting up a Luxembourg SOPARFI to then buy two French target companies, Target Co. 1 and Target Co. 2.
Right. So our job here is to kind of cut through all that dense information.
Yeah, pull out the really critical bits, make sense of the key aspects for this type of transaction, specifically in the Luxembourg context.
Okay, so where do we start? Structuring the deal via the SOPARFI, I suppose?
Let's do it. First things first. What is a SOPARFI, fundamentally?
Yeah, good question. Because interestingly, it's not actually a distinct legal form in itself. No, it's just a standard Luxembourg commercial company. Typically an SA that's a public limited company, or an SARL, a private limited one. And the SOPARFI label just means it's set up to benefit from Luxembourg's tax advantages, specifically for holding and managing financial participations. That's its main thing.
Okay, so it operates under the main company law.
Exactly. It's governed by the big law of 10 August 1915 on commercial companies. That's the bedrock.
So its main job, day-to-day, is holding shares in subsidiaries, either Luxembourg ones or foreign ones.
That's the primary activity, yes, holding shares. But it can do more. Well, if it's written into its Articles of Association, and crucially, if it gets the right licenses, it could also do related financing, maybe even other commercial activities.
But the tax benefits are tied to the holding part.
Primarily, yes. That's where the main advantages lie.
And why Luxembourg? What makes it such a hotspot for these international holding structures?
Well, Luxembourg has worked hard to create a very attractive legal framework. Plus, it has a huge network of double tax treaties.
Right. The treaties are key.
And it implements all the relevant EU directives. So that whole package, the laws, the treaties, the EU compliance, makes it really appealing for international investors looking for like a stable and efficient hub.
Makes sense. Now, if Parent Co. goes down this path, they have that choice, SA versus SAR.
Yeah.
What are the key differences they need to weigh up?
This is a really important strategic choice up front. Both are very common, but they have different characteristics.
Right.
The SA Public Limited needs a minimum share capital of 30,000 euros, but only 25% of that, so 7,500 euros, has to be paid in at the start.
And the SARL, Private Limited.
That one has a lower minimum capital requirement, just 12,000 euros. But the catch is, it has to be fully paid up from day one.
That lower amount for the SARL, 12,000 fully paid, might look tempting.
It might seem that way, especially, if Parent Co. just wants a simple, stable, wholly owned setup.
But there's more to it.
Yeah, like shareholders. Both can start with just one shareholder. But an SA, well, it can have an unlimited number of shareholders. And an SARL is capped at 100.
Okay. And transferring shares. Is that different?
Big difference. SA shares are generally freely transferable. You can buy, sell, no problem, unless the articles say otherwise. And you can even list them on a stock exchange. That gives you a lot of flexibility later.
Right. And the SARL shares, more restricted.
Much more restricted. If you want to sell SARL shares to someone who isn't already a shareholder, you typically need approval from shareholders holding at least 75% of the capital.
75%. Wow.
Yeah, though the articles can lower that threshold. But crucially, you cannot list SARL shares on an exchange.
Okay. And setting them up, notary involvement, audits.
Both require a notary for incorporation. That's standard. Audits, well, that depends on size based on thresholds for balance sheet, turnover, number of employees. Smaller ones might be exempt.
So weighing it all up, the SARL's lower capital is appealing. Short term, maybe.
But the SA's flexibility, especially for future changes like selling shares, bringing in partners, restructuring, that often makes it the preferred choice for international holding structures, even with the higher initial capital hurdle. It's about the long game.
That makes a lot of sense.
Yeah.
Okay, decision made on the legal form. What's the actual process of getting the SOPARFI incorporated, step by step?
Right, the practicalities. Stage 1 is preparation. Define the project, check feasibility. You need to check the company name is available with the RCS, the Trading Companies Register, which you do via the LBR, the Luxembourg Business Registers.
Okay, name check first.
And define the company's purpose, the objet social.
Yeah.
Getting legal advice at this stage is, frankly, essential.
Definitely. Then drafting documents.
Correct. Next up is drafting the statutes, the Articles of Association. This lays out everything. Name, form, registered office, purpose, capital, shares, governance, all the core details.
Got it. Then money.
Yep. Open a Luxembourg bank account, deposit that minimum capital, remember at least $7,500 for an SA paid up, or the full $12,000 for an SARL. The bank then gives you a blocking certificate. Proof the money's there.
And the notary seals the deal.
Pretty much. The actual deed creating the company is executed before a Luxembourg notary. It's interesting. Electronic signatures are possible for some steps now, too.
Handy.
Then you file that notarized deed and the bank certificate with the RCS. You can actually do this online now through the LBR portal if you have a Lux Trust digital ID.
Okay, and make it public.
Yes. A notice goes into the official electronic gazette, RISA again, filed via LBR. And then Parent Co. gets its official registration document, the extra RCS.
That sounds pretty efficient, actually. How long does all that take, roughly?
Well, once the bank account is open and the capital's deposited, which can take time itself with bank KYCML checks.
Ah, the bank procedures.
Exactly. But after that, the notary filing publication bit is usually quite fast, maybe just a few business days. The whole end-to-end process, including the banking setup, you're probably looking at around, say, 3 weeks typically.
Okay, 3 weeks, give or take. So the SOPARFI exists legally. What about keeping it running properly, the ongoing compliance side?
Super important. This isn't set and forget. First, it absolutely must have a registered office in Luxembourg.
Physical address?
Yes. Often companies use a domiciliation agent for the service. Second, you have to hold an annual general meeting, an AGM, at least once a year. That's mainly to approve the annual accounts.
And those accounts need filing?
Yes. Prepared under LuxGap, generally accepted accounting principles, and filed with the RCS every year.
What about audits again? Always required?
Not always. Only if the SOPARFI hits certain size thresholds, balance sheet total, net turnover, average employees. Smaller companies often fall below these and are exempt.
Okay. And management.
You need to appoint the management body. For an SA, that's a board of directors. For an SARL, it's one or more managers.
Right.
And, of course, keep proper books and records accounting, corporate documents all maintained at the registered office, plus the annual tax filings, CIT, MBT, NWT returns, and VAT returns, if it does anything VAT related.
So quite a bit of regular admin.
Absolutely. And it's crucial, not just for legal good standing, but it also reinforces the economic substance in Luxembourg. That's vital for the tax side, as we'll see.
Let's talk about that substance requirement then. You mentioned it's critical. Why? And what does it actually mean for this SOPARFI?
It's incredibly important, especially now with the global focus on tax transparency and preventing base erosion and profit shifting, the BEPS project, the use ATAD rules.
Right, the international crackdown on shell companies.
Exactly. If your SOPARFI is seen as lacking genuine substance in Luxembourg, you can run into major problems. You could be denied treaty benefits like the reduced withholding tax from France. Denied EU directive benefits.
Serious consequences.
Very. You could face challenges under anti-abuse rules, both general ones and specific ones in treaties like the Principal Purpose Test. And there's this proposed EU directive, ATAD 3, the Unshell Directive, which specifically targets entities lacking substance.
So how do you prove you have substance? What are they looking for?
It's based on the overall facts and circumstances. No single magic bullet, but key indicators include where are the real decisions made.
The strategic ones.
Yes, key strategic and management decisions about the holdings, buying, selling, financing dividends should genuinely happen in Luxembourg. You need evidence, like board minutes from meetings held physically in Luxembourg showing real discussion.
And the people involved.
The directors or managers. Are they qualified? Are they actively doing their jobs? Ideally, a majority might be Luxembourg residents or live nearby in the border regions, and depending on the scale, you might even need actual employees in Luxembourg.
So just having the registered address isn't enough?
Definitely not enough on its own, especially if it's just a service provider's address. You ideally need appropriate physical office space in Luxembourg relative to the activity and an operational bank account there, or at least in the EU.
Okay, so if Parent Co. tries to run this purely from France, with maybe nominee directors in Lux. That's risky.
Extremely risky. That's exactly the kind of setup that gets challenged. The SOPARFI needs its own resources, its own autonomy to genuinely manage those French investments from Luxembourg. Documenting that Luxembourg-based decision-making is absolutely vital.
Crystal clear. Substance is non-negotiable. Okay, let's switch to the Luxembourg tax framework itself.
Yeah.
How does it apply to this SOPARFI?
Right, the core tax profile. Fundamentally, SOPARFI is a fully taxable resident company in Luxembourg.
Fully taxed?
Yes. It's subject to corporate income tax, CIT, municipal business tax, MBT, and net wealth tax, NWT, on its worldwide income and assets, unless specific exemptions kick in.
And that taxable status is important.
Crucial. It's what allows the SOPARFI to benefit from Luxembourg's double tax treaties, like the key one with France, and EU directives like the parent subsidiary directive. It's different from, say, an SPF, which is tax-exempt. The SOPARFI name really just signifies this taxable holding company regime that can get these exemptions.
Got it. What are the tax rates right now for CIT and MBT? This is as of early 2025.
Okay, so for CIT, as of January 1st, 2025, it's tiered. If your taxable income is over 200,000 euros, the rate's 16%.
16.
If it's 175,000 euros or less, it's 15%.
15 or 16.
Plus, there's the solidarity surcharge, 7% of the CIT amount. So for income over 200K, the effective CIT rate becomes 17.12%.
Right, and the MBT, municipal business tax.
That varies by location. In Luxembourg City, which is common, the rate is 6.75%. So if you add it all up, CIT, surcharge, MBT, and Lux City, for income over 200K, the combined effective rate is 23.87%, which is actually down a bit recently.
23.87%. But you said the real efficiency comes from exemptions, not that headline rate.
Exactly. The core tax benefit for ParentCo using this structure for its French subs relies heavily on Luxembourg's participation exemption. That's what can shield dividends and capital gains from those subsidiaries from Lux tax.
Before we get to that exemption, what about net wealth tax, NWT? How does that work?
Right, NWT. It's an annual tax levied on the company's net asset value as of January 1st each year.
And the rate?
The standard rate is 0.5% on net assets up to 500 million euros, and then 0.05% on anything above that.
Okay, but isn't there a minimum NWT?
Yes, and that changed for 2025. It used to depend on asset types, but now it's purely based on the total balance sheet size. It ranges from 535 euros for small balance sheets up to 4,815 euros for those over 2 million euros.
So how does a SOPARFI holding these valuable French shares avoid a big NWT bill?
Through the NWT participation exemption. Basically, if the shareholding in the French target coast qualifies for the income tax participation exemption, which we'll get to next, then the value of those shares is excluded from the NWT calculation base.
So the exemptions are linked.
Yes. Since ParentCo is buying 100% of the targets, they'll almost certainly qualify, meaning the SOPARFI's NWT base should be drastically reduced, likely leaving only the minimum NWT amount payable. Qualifying IP can also be exempt, by the way.
Okay, that's crucial. Now, let's really dive into that income tax participation exemption. You said it's the cornerstone.
It absolutely is. This regime, mainly from Article 166 of the Income Tax Law, LIR, and related rules, is what makes the SOPARFI structure so powerful for holding investments. It exempts qualifying income from substantial shareholdings from both CIT and MBT.
Qualifying income being dividends and capital gains.
Exactly. Dividends, including liquidation proceeds and capital gains on the sale of the shares.
So what makes a holding qualifying and substantial? What are the conditions?
Okay, several layers. First, the parent, our SOPARFI, must be a fully taxable Luxembourg resident company.
Check.
Second, the subsidiary, the French target coast, must be eligible. This means either an EU parent subsidiary directive company, which French SSRLs generally are, or another fully taxable Lux company, or a non-resident company subject to a comparable income tax.
Comparable tax, how is that defined?
As of 2025, it means a minimum statutory income tax rate of at least 8%. Standard French corporate tax usually clears this bar easily.
Okay. And the substantial part, minimum ownership, holding period.
Yes. The SOPARFI needs to hold either at least 10% of the subsidiary's nominal paid-up capital, or the acquisition cost of the shares must be at least 1.2 million euros for the dividend exemption, or 6 million euros for the capital gains exemption.
10% or our 1.26 million euro cost. Got it.
And the holding period. You need to hold or commit to hold the shares for an uninterrupted 12 months. This period needs to cover the date you receive the dividend or realize the capital gain.
But you can get it provisionally if you commit to holding for 12 months.
That's right. The exemption can apply provisionally based on that commitment.
So, for Parent Co. buying 100% of the French targets, they clearly meet the 10% threshold. If they hold for 12 months, dividends from France and any future sale proceeds should be tax-free in Luxembourg.
That's the expected and intended result, assuming the French companies are subject to standard French tax.
You mentioned a new option for 2025 to not apply the exemption.
Yes, but it's very specific. You can only choose to waive the exemption if you only qualify based on the acquisition cost thresholds, the 1.2 meter or 6 meter euros, and not based on the 10% shareholding. It's an annual choice per holding, really aimed at complex situations like managing loss utilization or Pillar 2 tax impacts, unlikely to be relevant for this straightforward 100% acquisition.
Okay, clear. What about withholding taxes, money flowing between France and Luxembourg?
Good question. Let's look at dividends flowing up from the French targets to the Lux SOPARFI first.
Okay. Does France withhold tax?
Under the France-Luxembourg double tax treaties, specifically Article 10, France can tax dividends paid to a Lux resident, but the rate is limited.
How limited?
Usually it drops to 0% if the beneficial owner is a Lux company holding at least 5% of the capital for 365 days, including the payment day.
5% for 365 days. Parent Co. owns 100%, so that should be 0% French WHT.
Exactly. That's a typical outcome for this kind of structure, assuming the targets are standard companies, not specific real estate vehicles, which have different rules. Always double-check the latest treaty text and French guidance, of course.
So dividends flow France to Luxembourg, potentially WHT free. What about the other way? SOPARFI pays dividends up to the French Parent Co. Does Luxembourg withhold tax?
Standard Luxembourg WHT on dividends is 15%.
15, okay.
However, it's usually eliminated in this scenario. Luxembourg has its own domestic participation exemption WHT waiver.
Mirroring the income exemption.
Pretty much. If the recipient Parent Co. here is a qualifying EU treaty resident, subject to comparable tax, and meets the holding threshold, 10% or EUR 1.2 meter cost, and the 12-month period, then the Lux WHT is waived, full exemption.
So Parent Co. should qualify for that?
Yes, and even if not, the DTT itself would likely reduce the rate possibly to 0 too, aligning with the domestic waiver.
So potentially tax-free flow both ways for dividends. That's a major plus.
Yeah.
What about interest if the SOPARFI borrows to fund the acquisition?
Generally, Luxembourg doesn't levy WHT on arm's-length interest payments.
Arm's length being key.
Absolutely. So interest paid by the SOPARFI, whether to a bank or even Parent Co., shouldn't face Lux WHT unless it's something unusual like profit-participating debt.
And interest paid from the French targets to the SOPARFI, French WHT.
The DTT usually grants exclusive taxing rights to the recipient state, Luxembourg. So typically 0% French WHT on arm's-length interest going up to the SOPARFI.
And liquidation, if the SOPARFI is wound up someday.
Liquidation proceeds distributed by the SOPARFI are also exempt from Luxembourg WHT.
Okay, that covers withholding taxes. Let's touch on VA. How does V8 affect a pure holding SOPARFI?
Right, V8T. If the SOPARFI is genuinely just acquiring, holding, and maybe selling shares, no active management involvement, those activities are generally considered outside the scope of Luxembourg V8.
So it's not a VA taxable entity for that?
Typically not. A pure holding company isn't usually registered for V8 just for holding shares.
What's the catch?
The catch is input V8 recovery. Because it's not making V8able supplies, the pure holding SOPARFI generally cannot deduct the input via it incurs on costs related to holding those shares.
Like the fees for advising on the acquisition.
Exactly. Those M&A advisory fees, legal fees related to the holding function, the V8 on those costs becomes irrecoverable. It's just an added expense.
What if the SOPARFI does more? Like charges management fees to the target co's?
Then it changes. If the SOPARFI provides services like management, admin, technical support for a fee, those are usually taxable economic activities.
So it becomes VA registered then?
Potentially, yes. It would likely become a mixed V8 taxable person. This could allow it to recover some input, VAT specifically, the VAT on overheads related to those taxable services.
But not the VAT on the acquisition costs.
Probably still not the VAT directly linked to the share acquisition itself. That usually remains non-deductible, even for a mixed entity.
And VAT grouping, does that help?
Luxembourg allows VAT grouping if companies have close financial, economic, and organizational links. A pure holding company can be part of a group, but even then the rule generally holds. VAT on costs directly for shareholding isn't recoverable at the group level.
So bottom line for Parent Co, if the SOPARFI is just holding shares, expect the VAT on deal fees to be a sunk cost. Getting clever with services adds complexity and substance needs.
Precisely.
It's a trade-off.
Okay. Last big piece on the tax framework, the impact of all the EU tax directives. We mentioned ATAD, BEPS. How do they interact here?
They're hugely important and create a complex overlay. First, the parent subsidiary directive. That's fundamental.
Facilitating dividends. Yes, aiming for tax-efficient profit flows within the EU. Generally means no WHT on dividends between qualifying companies, and the parent state exempts or credits the income. SOPARFIs usually benefit both receiving from EU subs, like the French targets, and paying to EU parents, like Parent Co., but subject to conditions and anti-abuse rules.
What about the merger directive?
That one allows for tax deferral on capital gains during cross-border reorganizations within the EU. Might be relevant for future restructuring, maybe merging the targets later.
Okay. Then the anti-tax avoidance directives, ATAD 1 and 2.
These bring in several key measures. Interest limitation rules, or ILR.
Limiting interest deductions.
Yes. Net interest expense deductions are capped, usually at 30% of tax EBITDA, or a €3 million safe harbor, whichever is higher, affects how you finance the deal.
What else from ATAD?
Hybrid mismatch rules. These neutralize tax advantages if, say, an instrument is treated as debt in one country, deductible interest, and equity in another, exempt dividend. Needs careful review of any cross-border financing.
Any others?
Controlled foreign company, CFC rules, potentially attributing income from low-tax subsidiaries back to the parent. Unlikely to bite here with normally taxed French targets that they exist, and a general anti-abuse rule, GAR, allowing tax authorities to ignore arrangements set up mainly for a tax advantage. Again, emphasizes substance and commercial rationale.
You mentioned DKey 6 and Pillar 2 earlier, too.
Yes. DSI 6 means mandatory reporting of potentially aggressive cross-border tax arrangements. Setting up this structure is cross-border, so it needs a DC 6 check to see if reporting is required.
And Pillar 2.
The global minimum 15% effective tax rate only impacts very large groups over €750 million consolidated revenue. If Parent Co's group is that big, the SOPARFI and targets are in scope. If their effective tax rate in Lux or France is below 15%, top-up tax could apply. Luxembourg has enacted its version, the QDMTT. It's complex.
And finally, ATAD 3, the Unshelled Directive, still proposed.
Still proposed as of our recording date, but very relevant directionally. It targets EU entities lacking minimum substance indicators, focusing on passive income, cross-border activity, outsourced management.
And the consequence.
Potential denial of tax residency certificates, treaty benefits, maybe increased information sharing. Even though not law yet, it heavily reinforces that need for genuine economic activity and presence in Luxembourg for the SOPARFI. Can't just be a mailbox.
Wow, so it's a real minefield. Tax efficiency is possible, but it's heavily conditioned by anti-abuse rules, substance requirements, maybe minimum taxes.
Exactly. The days of simple artificial structures are over. You need robust substance, clear commercial wrongs for the structure, and careful navigation of all these overlapping rules.
Okay, that's a fantastic overview of the Luxembourg holding company and tax landscape. Let's take a short break, and when we come back, we'll shift focus to France and the legal and regulatory side of actually acquiring those target companies. Don't go anywhere. Mid-show break, simulation resume after. Welcome back to our deep dive on structuring a Franco-Luxembourg acquisition via a SOPARFI. Before the break, we thoroughly covered the Luxembourg entity's setup, tax, and substance issues.
Yes. And now we need to look across the border to France at the process of actually acquiring the shares of Target Co. 1 and Target Co. 2.
So, legally, how does a share acquisition work in France? What's the framework?
It's primarily governed by French law, the civil code for contract law aspects, and the commercial code for company law specifics.
And the mechanics. How do shares change hands?
Through share purchase agreements, or SPAs, obviously, but also physically through inscriptions in the target company's share transfer registers, the Registre des Mouvements de Titres, and updating the shareholder accounts, the compte d'actionnaire. The exact formalities depend a bit on the legal form of the target coast, like whether they are an SA or SAS.
Okay, standard enough.
Okay.
But are there specific French pre-deal procedures we need to know about, especially involving employees?
Yes. This is a crucial French-specific point. There are mandatory procedures involving employees that must happen before you can even sign a binding SPA.
Before signing. Okay, what are they?
First, if the target company has more than 50 employees, you need to consult its Social and Economic Committee, the CSE.
Consult them on what?
On the proposed acquisition itself and its likely consequences for the company and employees. You have to provide them with detailed information and give them a set time frame, usually 1 to 3 months, to issue a formal opinion.
You have to wait for that opinion before signing the SPA.
Yes. Failure to consult properly can lead to legal challenges, even potentially suspending the deal. It's a serious procedural requirement.
Okay. CSE consultation for larger companies. Anything else?
Yes. There's also the Loi Himon employee information right. This applies mainly to SMEs under 250 employees and below certain financial thresholds.
And what does Loi Himon require?
It requires that employees must be informed about a proposed sale that involves a controlling stake, usually 50% or more, or the entire business. This information has to be given at least 2 months before the sale is finalized.
Why inform them? So they can object.
The idea is to give them a chance to submit their own offer to buy the company. The seller isn't obligated to accept it, but they must be given the opportunity. This runs in parallel with any CSE consultation.
And a penalty for not complying with Loi Himon.
A civil fine, potentially up to 2% of the sale price.
Wow. Okay, so these French employee consultation and information rights are major. They directly impact the deal timeline and have to be completed before the SPA is even signed.
Absolutely. They need to be factored into the transaction plan from the very beginning, and completion of these procedures will be critical conditions, precedent, or CPs in the SPA itself.
Makes sense. Now, before signing anything, Parent Co, via its advisors, will need to conduct thorough due diligence on the French targets. What should they focus on?
Yes, comprehensive DD is essential. Legal, financial, tax, commercial, operational, HR, environmental, compliance, the works.
Are there any particular French nuances to watch out for in DD?
Definitely. French employment and labor law is complex and critical. You need to scrutinize employment contracts, collective bargaining agreements, working time rules, the relationship with the CSE, any ongoing employee claims, pension obligations, benefits. It's a huge area.
What about compliance?
Big focus there, too. Compliance with SAPENS II, which is France's anti-corruption law. For larger companies, the duty of vigilance law covering human rights and environmental risks in supply chains, and of course, GDPR compliance.
Okay. Anything else specific?
Reviewing key contracts is vital. Customers, suppliers, financing, leases. Look carefully for change of control clauses or restrictions on assignment. Regulatory compliance is also key. Does the target have all necessary permits, licenses, authorizations? And naturally, deep dives into the financials and tax situation accuracy of past accounts, compliance with French CIT, VAT, local taxes, identifying potential liabilities or risks, understanding available tax attributes.
So the DDD findings feed directly into the SPA negotiation.
Absolutely. They inform the valuation, identify risks that need to be covered by representations and warranties, R&Ws, or specific indemnities in the SPA, and help define what needs to be fixed before closing, forming the basis for other CPs.
Okay, let's talk regulatory hurdles. Foreign direct investment screening, or FDI, does that apply here? Luxembourg SOPARFI, buying French companies.
Good question. Both Luxembourg and France do have FDI regimes designed to protect national security and public order.
Let's start with Luxembourg. Does the SOPARFI buying French targets trigger Luxembourg FDI?
Likely no. Luxembourg's FDI regime, which came into effect in September 2023, focuses on investments into Luxembourg entities operating in critical sectors by non-EEA investors.
So Parent Co is French, EEA. The SOPARFI is Luxembourg, EEA. The targets are French, EEA. It's all within the EEA.
Exactly. The flow isn't into Luxembourg from outside the EEA. So Luxembourg FDI screening shouldn't be triggered by this specific acquisition structure.
Okay, that's Luxembourg. What about France? Does French FDI apply when a Luxembourg entity buys French targets?
Yes, it absolutely can apply. The French regime, known as IEF, covers investments by foreign investors, and for this purpose, a Luxembourg company, even if owned by a French parent, is considered a foreign investor into French companies operating in sensitive sectors.
Sensitive sectors. What qualifies?
It's a broad list defined by decree. It includes obvious things like defense, dual-use goods, critical infrastructure like energy and transport, but also sectors like public health, critical technologies, R&D, think AI, robotics, cyber, biotech, semiconductors, energy storage, data hosting, food security, media, and even some aspects of finance.
Okay, quite wide-ranging. And what triggers the review? Just buying shares.
It's triggered by acquiring control of a French entity in a sensitive sector, acquiring all or part of a branch of activity, or crossing certain voting rights thresholds. For an EVA investor like our SOPARFI, acquiring 100% control would definitely trigger it if either target co operates in one of those sensitive sectors.
So what's the procedure if a target co is in a sensitive sector?
The SOPARFI must file for prior authorization with the French Minister of Economy, handled by the Treasury Directorate, DG Trésor, before closing the deal.
Before closing. And it's suspensory.
Yes. The deal cannot close until approval is granted. There's potential Phase 1 review, up to 30 business days, and if needed, a Phase 2, adding another 45 business days. The minister can approve with conditions attached, or block the deal entirely.
So a crucial first step for parent co is figuring out immediately if target co 1 or 2 operate in any French sensitive sectors.
Absolutely critical. If they do, French FDI approval becomes a mandatory condition precedent in the SPA, and it will significantly impact the transaction timeline.
Got it. FDI is one hurdle. What about merger control? Antitrust clearance.
Also potentially applicable, yes, if certain turnover thresholds are met. We need to look at EU, Luxembourg, and French rules.
Okay. EU level first.
EU merger control only applies if the deal has an EU dimension, meaning very high combined worldwide and EU-wide turnovers for parent co's group and the targets. Based on a typical scenario, this is probably unlikely unless parent co is a massive multinational group.
Okay, probably not EU level. What about Luxembourg? Do they have merger control?
Historically, Luxembourg didn't have a mandatory pre-merger filing system. However, there's a bill 8296, introduced in 2023, that proposes a national regime. It was expected to become law possibly in 2025.
So we need to check if that's enforced now in May 2025. And what are the proposed thresholds?
The proposed thresholds, if the EU ones aren't met, are an aggregate turnover in Luxembourg of all companies involved exceeding 60 million euros, at least 2 of the companies involved each having an individual turnover in Luxembourg of at least 15 million euros.
Turnover in Luxembourg. So unless parent co and the targets have significant existing sales within Luxembourg itself, this proposed regime is also unlikely to be triggered.
That seems likely, yes. But the status of that law and the exact thresholds would need verification with Luxembourg Council as of today.
Right, so that leaves French merger control. Is that likely to apply?
This one is much more likely. French merger control, enforced by the Autorité de la Concurrence, applies if the deal doesn't hit EU thresholds but meets French ones.
What are the French thresholds?
The standard ones are aggregate worldwide turnover of all companies involved exceeding 150 million euros, A&D aggregate turnover in France of at least 2 of the companies involved exceeding 50 million euros.
Worldwide and French turnover. Given parent co is acquiring 2 French companies, it seems quite probable their combined turnovers would hit those French thresholds.
Yes, it's highly probable. It depends on parent co's existing size and the size of the targets, but often these thresholds are met in acquisitions like this.
Are those thresholds stable? Any recent changes?
Good point. There was a proposal in 2024, part of a simplification law, to potentially increase these thresholds maybe to 250 million worldwide and 80 million in France for the 2 parties. So verifying the exact thresholds applicable today, May 2025, is crucial.
Anything else changing in French merger control?
There's also been discussion, following a major European court case, Illumina-Grail, about giving the French autorité a call-in power to review problematic mergers, even if they fall below the standard thresholds. Again, the exact status and scope of such a power would need confirmation with French counsel.
Okay, so assuming French merger control is triggered, what's the process?
Notification is mandatory and suspensory. You can't close before clearance. There's typically a Phase 1 review lasting up to 25 working days, possibly extended. If no competition concerns arise, they clear it, maybe with conditions. If there are concerns, they open an in-depth Phase 2 investigation, which can take up to another 65 working days, again extendable.
So securing French merger control clearance is likely another major condition precedent and timeline driver.
Almost certainly, yes. Expect weeks, potentially months added to the timeline just for this.
Okay, one more directive to mention, the EU Mobility Directive on cross-border mergers and divisions. How does that fit?
Right. Directive 219/2121. Luxembourg was expected to transpose this into national law around early 2025. It harmonizes the rules across the EU for companies doing cross-border conversions, mergers, or divisions.
But this deal is a share acquisition, not a merger itself.
Correct. So it doesn't directly govern this transaction, but it's relevant context for any potential future reorganization. Say, if parent co later decided to merge the target co's into the SOPARFI or vice versa.
What does the directive change?
It sets out common procedures, things like draft terms, management reports, independent expert reports, shareholder approvals, getting pre-operation certificates. It also strengthens rights for minority shareholders, like exit rights, creditors, and, importantly, enhances employee information, consultation, and participation rights in these cross-border moves.
So something to be aware of for long-term planning.
Exactly. Good corporate housekeeping to know the framework exists for future steps.
Okay, we've covered the French legal and regulatory landscape for the acquisition itself. Now let's bring the two jurisdictions together and look at the tax implications of the combined Franco-Luxembourg structure.
Right. The interaction between the two systems, primarily governed by the Double Tax Treaty, or DTT.
Which treaty are we talking about? There was a recent one, wasn't there?
Yes, the current France-Luxembourg DTT was signed in March 2018 and came into force January 1st, 2020. It replaced an older 1958 treaty and incorporates the OECD BEPS standards.
And wasn't there a recent update or protocol?
Yes, an amending protocol signed in late 2022 came into force just recently, March 4th, 2025. However, based on available information, that protocol mainly dealt with cross-border worker taxation and didn't fundamentally change the core articles on corporate dividends or capital gains that we're interested in here.
Okay, so based on the 2018 treaty, let's revisit dividends. French targets paying up to the SOPARFI. We said likely 0% French WHT.
Correct. Article 10 of the treaty allows France to tax, but limits the rate. It should be 0% if the beneficial owner, the SOPARFI, holds at least 5% of the capital for 365 days, including payment date. With 100% ownership, that condition is met.
And Luxembourg's taxation of those incoming dividends?
Should be exempt under Luxembourg's domestic participation exemption, as we discussed, assuming eligible entities, 10% threshold met, 12-month holding period met.
Okay, so dividends look efficient. What about capital gains? If the SOPARFI later sells the shares of the French target coast, who gets to tax the profit?
Under Article 13 of the DTT, the general rule is that the exclusive right to tax capital gains on shares goes to the seller's country of residence, so Luxembourg.
Meaning France doesn't get to tax the gain.
Usually not. However, there's a very important exception for shares in real estate-rich companies.
Ah, the property clause.
Exactly. France retains the right to tax the capital gain if the shares sold derive more than 50% of their value, directly or indirectly, from immovable property situated in France. This is tested at any point during the 365 days before the sale.
So if the target codes are standard operating businesses, not primarily holding French real estate, then France shouldn't tax SOPARFI's gain on exit.
That's the general position. Verification against the specific assets of the target codes is needed, but typically yes.
And Luxembourg's taxation of that capital gain.
Again, it should be exempt under the Luxembourg participation exemption, provided the conditions are met. Eligible entities, 10% holding, or EUR 6-meter acquisition cost, 12-month holding period.
Okay, what about interest again? Loans from SOPARFI down to targets.
Article 11 of the DTT generally says interest arising in France and paid to a Lux resident is taxable only in Luxembourg. This implies 0% French WHT on arm's-length interest paid by the targets up to the SOPARFI.
So the treaty seems very helpful for this structure. Any catches? Anti-abuse rules in the treaty itself.
Yes, a big one. Article 28 contains the Principal Purpose Test, or PPT. This is a standard feature now based on BEPS Action 6.
The PPT, what does it do?
It allows tax authorities, in this case, potentially the French authorities, to deny the benefits of the treaty, like the 0% dividend WHT or the capital gains exemption at source, if it's reasonable to conclude that obtaining that benefit was one of the principal purposes of the arrangement or transaction. Unless granting the benefit in that specific situation would be in accordance with the object and purpose of the treaty provisions.
So it targets treaty shopping and artificial structures.
Precisely. Structures that lack genuine substance or a clear commercial purpose beyond just grabbing a tax benefit are vulnerable. The burden of proof might even fall on the taxpayer to show legitimate non-tax reasons.
So even though the treaty technically allows 0% WHT, the French authorities could challenge it using the PPT if they think the SOPARFI is just a conduit lacking substance.
Absolutely. This reinforces the critical importance of that Luxembourg substance we discussed earlier. The SOPARFI needs to be real, with genuine functions and decision-making in Luxembourg to withstand potential PPT scrutiny from France. You can't just rely on the letter of the treaty articles.
Okay, substance is key for treaty benefits too. Now, thinking about financing the acquisition itself, how is interest deductibility handled in Luxembourg for the SOPARFI?
Generally, interest expenses incurred by the SOPARFI on loans taken out to acquire the participations in the target codes are deductible for Luxembourg tax purposes.
But subject to limitations.
Yep.
Like the ATAD interest limitation rule we mentioned.
Exactly. Luxembourg implemented the ATAD ILR in Article 168 bis of the LIR. This limits the deduction of exceeding borrowing costs, basically net interest expense, to the higher of 30% of the company's tax EBITDA, or a €3 million threshold per year.
Okay, 30% of EBITDA or 3 million?
Yes, there are rules for carrying forward unused interest expense or unused capacity, and some exceptions exist, like for standalone entities or potentially under an equity escape clause, though the rules for single entity groups changed in 2025, so applicability needs careful checking based on the SOPARFI's specific situation and group structure.
What about loans from parent co itself, related party debt?
Two key things there. First, the interest rate must be at arm's length. It has to be comparable to what independent parties would agree. You'd need transfer pricing analysis and documentation to support the rate charged. Luxembourg updated its guidance on this in early 2025, emphasizing arm's lengths for all related party loans.
Arm's length principle. What's the second thing?
Thin capitalization. While Luxembourg doesn't have rigid statutory debt-to-equity ratios, the tax authorities can still challenge interest deductions if the SOPARFI is excessively leveraged compared to its assets and activities.
Is there a guideline ratio people use?
An 85.15 debt-to-equity ratio is often cited as an informal guideline for holding activities, but it's not a safe harbor. It depends on the facts. If the debt is deemed excessive, part of the interest could be reclassified as a hidden, non-deductible dividend distribution.
And the ATAD hybrid mismatch rules could also play a role in financing.
Yes. If the financing instrument used between, say, parent co and SOPARFI is treated differently in France and Luxembourg, maybe deductible interest in Lux, but seen as an exempt dividend receipt in France, then the ATAD 2 rules in Luxembourg might deny the interest deduction to neutralize that mismatch. The specific features of the loan instrument matter.
So getting interest deductions requires careful planning around the ILR, arm's length pricing, reasonable leverage, and avoiding hybrid structures. Just loading up with related party debt is risky.
Very risky, yes. Needs proper structuring and documentation.
We've touched on anti-abuse rules like the DTT-PPT. Are there other domestic anti-abuse provisions in France or Luxembourg to worry about?
Yes, both countries have their own general and specific anti-abuse rules, GIRs and SARs, that overlap with the treaty PPT.
Like what in Luxembourg?
Luxembourg has its main GAR in paragraph 6 of the Tax Adaptation Law, section 6, stan PG, which allows disregarding non-genuine arrangements mainly set up for a tax advantage contrary to the law's purpose. There's also a specific anti-abuse rule targeting the parent subsidiary directive benefits, like the participation exemption for dividends, if the setup is non-genuine and mainly aims to defeat the directive's purpose. Recent case law confirms this gets applied.
And in France?
France has a powerful anti-abuse concept called abus de droit fiscal. This allows the French tax authorities, DGFP, to disregard transactions that are either fictitious, simulation, or legally valid, but undertaken principally for tax evasion, fraud à la loi, in a way that goes against the legislator's intent. It's a significant tool they can use to challenge artificial structures.
What about CFC rules again? Could France use its CFC rules against the Lux SOPARFI?
France does have CFC rules, Article 209B of the CGI. Theoretically, they could target income parked in a foreign entity enjoying a privileged tax regime if the structure is artificial.
Would a standard SOPARFI be privileged? Its headline rate is over 20%, but the participation exemption makes its effective rate potentially zero on holding income.
That's the complexity. For EU entities, there's usually a main purpose test carve-out, meaning the CFC rules shouldn't apply if the structure isn't set up primarily for tax avoidance. Given Luxembourg's standard CIT rate and the EU-compliant participation exemption, a SOPARFI with genuine substance shouldn't typically be caught. However, the French authorities could still potentially challenge the artificiality of the structure itself under the CFC rules or the general abus de droit.
So it all comes back to substance and commercial rationale again.
Absolutely. It's the recurring theme. You have multiple layers of anti-abuse rules, Lux-SAR, French abus de droit, the DTT-PPT, potentially CFC rules. The only robust defense is having genuine non-tax reasons for using the Luxembourg holding structure, like centralizing group holdings, accessing Lux expertise, using a neutral platform, and ensuring the SOPARFI has real operational substance in Luxembourg decision-making, management resources to back up its role.
Without that, The whole tax efficiency plan could unravel.
Precisely. The structure becomes vulnerable to challenges from either Luxembourg or, perhaps more likely, French authorities, potentially jeopardizing the intended tax benefits like WHT exemptions or participation exemption.
Give a very important warning. Let's move to the practical execution. The share purchase agreement, the SPA. This is the core legal doc for the acquisition.
Yes, and being cross-border Lux buyer, French targets, French seller, parent co indirectly, requires careful drafting considering both legal systems and market practices.
First big question. Governing law and jurisdiction for the SPA, what are the options?
You could choose Luxembourg law, French law, or maybe even a neutral third country law like English law, which is sometimes seen in international deals.
What factors influence that choice?
Familiarity of the parties and advisors with the law. Substantive differences between the legal systems, things like implied terms, how warranties work, available remedies. France, for instance, has concepts like garantie de vice cachée, implied warranty against hidden defects, which differ from other systems. Luxembourg SPAs often show Anglo-Saxon influences.
And resolving disputes if something goes wrong.
You need to specify that too. Either litigation in national courts, and you need to specify which country's courts have jurisdiction, or arbitration. You'd specify the arbitration rules, like ICC, and the seat of arbitration.
Pros and cons of arbitration.
Often preferred for cross-border deals because it offers neutrality, confidentiality, procedural flexibility, and usually easier international enforcement of the award compared to court judgments.
So what's the likely choice here? French or Lux law?
Either is plausible. Choosing French law might align well since the targets are French and employer regulatory issues are French. Choosing Lux law aligns with the buyer entity. Using a neutral law like English adds another layer of complexity and cost. Aligning the governing law and the dispute resolution forum is generally recommended. It impacts how clauses are interpreted. Needs agreement early on.
Okay. What are the absolutely essential clauses you'd expect in this SPA?
The usual suspects. Definitions, the core sale and purchase clause, the purchase price section, including how it might be adjusted, maybe using completion accounts or a locked box mechanism. Then conditions precedent, CPs, representations and warranties, R&Ws, covenants, promises about conduct before and after closing, indemnification clauses, who pays if things go wrong, termination rights, closing mechanics, and miscellaneous boilerplate stuff.
And the critical CPs for this specific deal would be?
Definitely getting that French FDI approval if required. Getting French merger control clearance if required. Verifying completion of the mandatory French employee information consultation procedures. Ensuring that R&Ws are still true at closing, maybe subject to a materiality threshold. Complying with pre-closing covenants. No material adverse change, MAC, occurring. And obtaining any crucial third-party consents, like from banks or key contract partners.
Now, negotiating these clauses across borders, Luxembourg buyer, French target seller context. Are there typical sticking points or differences in market practice?
Yes, there can be nuances. The scope and detail of representations and warranties might differ. French practice puts a very strong emphasis on labor law R&Ws, understandably. Anglo-Saxon influenced SPAs, potentially used in Lux, might have more extensive R&Ws overall than a very traditional French SPA. How disclosure against warranties works the standard of fair disclosure for the disclosure letter needs clarity.
What about liability limits? Caps? Basket?
Always heavily negotiated. Caps on liability may be 20–30% of the purchase price is common in Lux market practice for general warranties, perhaps 10–50% in France, depending on the deal. Fundamental warranties like title to shares, capacity, and tax fraud are often capped higher or even uncapped. Baskets are deductibles whether the buyer absorbs small claims up to a threshold, deductible, or gets paid from $1 once the threshold is hit, tipping. De minimis thresholds to exclude tiny claims, and survival periods for claims how long the warranties last. Usually longer for fundamental, tax, and social security issues, maybe 12–36 months for general business warranties in Lux practice.
Purchase price adjustments, completion accounts versus lockbox. Any preference?
Completion accounts, where you adjust the price based on the target's balance sheet at closing, have traditionally been common in French M&A. The locked box mechanism, where the price is fixed based on an earlier balance sheet with protections against value leakage, is gaining popularity in both markets, especially in deals involving private equity or where price certainty is paramount. Depends on negotiating leverage and priorities.
Tax clauses must be crucial too.
Absolutely vital for the buyer, the SOPARFI. Detailed tax warranties and indemnities covering pre-closing periods, compliance history, tax rulings, transfer pricing, all essential. Cooperation clauses for handling pre-closing tax audits are standard.
And those French employee procedures.
The SPA must include R&Ws confirming compliance with the CSE consultation and Loyhemen information requirements. And, as mentioned, completion will be a CP.
So bridging any gaps in market expectations on these key points, especially R&Ws and indemnities, is key. Clear drafting is paramount.
Absolutely. Ambiguity is the enemy in an SPA.
What are some common pitfalls to avoid specifically in cross-border SPAs like this?
Regulatory missteps are a big one. Failing to correctly identify and comply with requirements in both jurisdictions, like the French FDI, merger control, or labor laws, can delay or even kill the deal.
Okay. What else?
Cultural and communication barriers. Misunderstandings between the French teams, parent co, targets, and the Luxembourg side, SOPARFI, advisors, can definitely hinder progress. Effective project management and communication are crucial. Ambiguous drafting, as we said, especially on price adjustments, liability, CPs, leads to disputes. Tax inefficiencies or risks overlooking tax implications in either country, misinterpreting the DTT, failing on substance, triggering anti-abuse rules, and underestimating post-closing integration challenges across borders.
So proactive planning, thorough DD, clear communication, and precise drafting by experienced cross-border legal counsel seem essential.
Couldn't agree more. You need advisors who understand both sides.
Okay, let's wrap up with execution considerations. Timeline and professional help. What's a realistic timeline for a deal like this?
It's definitely multi-phased, with dependencies across Luxembourg and France. You have to account for setting up the SOPARFI, doing the DD, navigating those French pre-signing employee procedures, potentially lengthy regulatory reviews, negotiating the SPA, and then closing. Realistically, you're looking at 6 to 12 months, possibly longer.
Can you break that down roughly?
Sure. Phase 1, maybe weeks 1 to 4, prep and structuring, appoint advisors, assess regulatory triggers, FDI, merger control, plan for substance. Phase 2, maybe weeks 3 to 6 concurrently. So far, incorporation and Lux name check, bank account setup, notary, RCS filing. Phase 3, maybe weeks 4 to 12, due diligence on the French targets. Phase 4 is crucial and variable. Regulatory filings, French FDI merger control or suspensory, and those French pre-signing employee processes. CSE consultation can take 1 to 3 months. Loyhemen needs minimum 2 months notice before final sale. This phase must largely complete before a binding SPA.
So SPA negotiation comes after DD and those French procedures?
Generally, yes. Phase 5, SPA negotiation and signing. This happens once DD is done and the French employee procedures are complete or sufficiently advanced. Signing happens, but closing is subject to CPs like the regulatory approvals. Phase 6, post-signing pending CPs, weeks or months waiting for regulatory clearances, satisfying other CPs, then the actual closing event. Phase 7, post-closing integration, maybe purchase price adjustments if using completion accounts, ongoing compliance.
So a complex process needing careful management. What kind of professional advisors are essential?
You need a coordinated team with expertise in both Luxembourg and France. Definitely Luxembourg legal advisors for the SOPARFI setup, Lux law aspects, French legal advisors for the target acquisition, French law, regulatory, labor, Luxembourg tax advisors for the SOPARFI regime, DTT, substance, French tax advisors for target issues, French implications of the structure, financial advisors or accountants, potentially cross-border for DD valuation, maybe SPA mechanisms, a Luxembourg corporate service provider or fiduciary for ongoing SOPARFI admin and domiciliation, and a Luxembourg notary for the incorporation.
Coordination between them all is key.
Absolutely essential. They need to work together seamlessly.
And costs. What drives the professional service fees for a deal like this?
Several factors. The sheer size and complexity of the transaction, the scope of the due diligence and what issues it uncovers, how intense the SPA negotiations become, the complexity of obtaining those regulatory approvals, French FDI and merger control, can be costly if complex, the structure of the acquisition financing, and of course, the experience level of the advisors and their fee structures, hourly rates, fixed fees, retainers, maybe success fees, client preparedness and involvement also play a role.
So expect significant fees given the cross-border nature advisors needed in 2 countries, the French specifics, and likely regulatory filings.
Yes, this type of transaction inherently involves significant advisory costs. Getting detailed proposals based on a clear scope from shortlisted advisors in both jurisdictions is crucial for budgeting accurately.
Okay, this has been an incredibly thorough exploration. To wrap up,
Well, this deep dive into using a SOPARFI to buy French companies really shows, I think, a structure that offers significant opportunities, but wow, does it demand careful navigation?
It really does. The combination of Luxembourg's holding regime and that Franco-Lux tax treaty can yield real tax advantages.
But, and it's a big but, it's all contingent on genuinely demonstrating that economic substance in Luxembourg and successfully managing that whole web of regulations we discuss.
And the French legal and regulatory side, especially around employee rights and FDI merger control, adds significant layers of complexity.
Yeah.
You absolutely need expert guidance there.
Couldn't agree more. So for you listening, if you're considering structures like this, remember that thorough due diligence, proactive engagement with regulators, and a meticulously drafted SPA aren't just procedural hoops.
They're essential safeguards, really.
Exactly. And that need for demonstrable substance in Luxembourg. I know we keep saying it, but it truly is the bedrock. It's what underpins the tax efficiency and your ability to withstand challenges.
We really hope this detailed exploration has given you valuable insights into the key things to consider.
Of course, for specific questions on your situation or to delve deeper into any of these points, we strongly encourage you to reach out to experienced legal and tax professionals, specialists in both Luxembourg and France.
Definitely seek that tailored advice. Thanks for joining us for this deep dive. If you found this useful, please do hit that subscribe button.
It really helps us bring you more content like this.
It was the Luxembourg Fundcast show for you today.